Well, welcome back to QAV America, Tony, episode 59. It's the first day of the new financial year in Australia, but Americans don't care about that.
No. Happy new financial year, Cam.
It's nearly the 4th of July. I said to my wife, who's an American, do you want to celebrate the 4th of July? She's like, yeah, not really. I was like, okay.
Oh, really? She doesn't want to go to the MAGA concert on the reflecting pool?
I will. I was just looking for an excuse to make a pumpkin pie. She goes, yeah, one pumpkin pie for Thanksgiving is enough. You don't need to get, we're going down the pumpkin pie slippery slope, she says. I do love making a pumpkin pie now. Well, I haven't checked. It's early morning here on Wednesday in Australia. I haven't checked what happened in the market in the US last night. Oh, it went up.
Went up.
Yeah. Went up. Well, I did my market recap yesterday. A few things going on in the US over the last week that have affected the market. There is some concern, I think, now that probably aggressive rate cuts aren't going to happen. With Kevin Warsh in at the Fed, there was some optimism, I think, initially that he was going to cut some rates, but I think people are thinking, maybe that's not going to happen. He seems to be signaling that he's going to do the right thing despite the political expectations. And they've got hotter inflation data, 3 consecutive months of strong payrolls, and people seem to think that there might be a second rate hike by the end of the year. Tony, what are you reading in the Wall Street Journal and all that?
Oh, it's the same. I guess it'll be very interesting because, he was appointed by Trump to specifically cut rates. The difficulty for him, for Warsh, is that he's not the only vote on the Fed, and the Fed still has other people who are at least acting a little bit independently and making up their own mind on rates, and the data doesn't support a rate cut at the moment. But I think the other interesting thing with the Fed that I'm reading is that Kevin Warsh is really pushing the line that the Fed has been too transparent, too much in the market, talking, jawboning as it's called, to try and influence what the market's doing, what interest rates are doing without having to change rates. And he doesn't like that. So he's going dark. And I think that'll be interesting because then the market's going to probably react to every piece of data as it comes out without being told how the Fed interprets it. They'll be jumping at their own conclusion. So may lead to some more volatility. And we're going back to the days prior to probably Greenspan and Bernanke, where it was just the Fed doesn't release a dot plot, just comes out when it makes a move and tells you about it after the fact. So it'll be very interesting.
Indeed.
Whether it's good or bad, I can't really say. I mean, the things evolved to being more transparent under the last couple of chairmen. So we'll see whether it's better or worse by not being as transparent going forward.
Well, the other thing, of course, that's going on is the Strait of Hormuz. I've got my Strait of Hormuz live tracker website open in front of me. I love this website. You ever looked at this?
No.
Shows you the status of the Strait of Hormuz.
Does it show you where the mines are?
No, it shows you where the ships are, but not where the mines are. I don't think anyone knows where the mines are.
I guess you can extrapolate that if the ships are there, the mines aren't.
Well, the ships aren't going anywhere. That's
like Battleship, like a game of Battleship, isn't it?
Yeah, Battleship, yeah.
D3.
Yeah. So according to the tracker, the strait is still closed for the 122 days, 23 hours and 29 minutes. It's been closed, according to this. Ships transiting now in the last 24 hours, 5, it says.
From where?
And there are. It doesn't.
Are they Iranian
say
or Western?
Well, it doesn't say.
Right.
Oh, yes, it does down here, actually. No, this is vessel seizures. Okay, that's different. I don't know. I don't know which ships are getting through, but the point is that 5 is not a lot.
No, and the interesting thing was the oil price dropped overnight as well.
That's, yeah. It's 73.42 according to this website.
Yeah.
Why? Who knows? There are 485 vessels waiting, 220 tankers, 147 bulk carriers, and 118 other. Now, this tracks the tanker spot rate, tracks the daily throughput, it tracks the war risk insurance, which is still rates as extreme. But yeah, normally, it says normal daily average is 60 ships. I thought it was more like 90 to 100 ships as the daily average in normal times. But either way, 5 is not a lot. So that's the current reality of the Strait. Oil prices dropping, but the ships aren't moving. So
Yeah. How do you explain that?
Well, I think reserves being released into the market is probably part of it.
It was. I don't think they've done that release for a while, and they must be getting very low on their reserves to release. So I would have thought the oil price should be rising, but I know there's discussions going on again in Qatar, but whether that's to open the straits or whether it's to release sanction-held money back to Iran, it's all very convoluted and underreported at the moment. So it's hard.
Willis Watcher.
I don't know how you could trade oil futures at the moment. It's just highly speculative and surprising it's going down. But
well,
anyway,
the market's like highly speculative, Tony. I don't know if you've picked this up. Did you pay attention to the SpaceX flight, Tony?
Yeah, I also saw a graph of companies that make no money and their performance versus companies that make money. And the losers are winning, if that makes sense. The companies that make no money have done better.
Yes. So speaking of SpaceX, it's risen again a little bit yesterday. So it's kind of still below where it was. It's peaked, but it's coming back up. What else have I got? The yield cushion. Despite rate anxiety and geopolitical noise, the US 10-year Treasury yield held relatively steady, tracking at 4.37%, down from the 4.56 highs seen earlier in June. So, go figure. Not really sure how that makes any sense, but there it is. What else is going on in the US? Big tech took a brutal beating last week. There was a big tech drawdown across the market over the last week since we last recorded. And as I mentioned to you on our Australian show yesterday, it looks like OpenAI is talking about pushing its float back after the disappointing, in some perspectives, what happened with SpaceX after its float. The price sort of dipped again after there was a big sell-off and people sort of ran away from it. So there is some talk that OpenAI might kick theirs down the road a little bit. But they also announced their own in-house inference chip. So there was a little bit of excitement around that. They're going to build their own chips. Everyone's building their own chips. No one wants to be tied to NVIDIA forever.
Right. Yep.
Which is interesting.
Mm-hmm.
And you mentioned something yesterday about the Korean market being shut down again, Tony.
Yep, another 8% trading halt. So the market was shut for 20 minutes. That occurred last week, and that helped to drive down some of the AI stocks in the US. But there's also, we've seen plenty of commentary. We talked about yesterday on the Australian show. Jeremy Grantham's come out calling it the AI boom, a bubble. The clearing bank, the central bank's clearing bank, which is based in Europe, came out saying the same thing, that there was a boom in data centers, there was a boom in AI chips and in AI stocks, and there was a circular economy going on. They claimed it was the situation looked as bad as before the GFC. So there's lots of people who are feeling a bit edgy about where the market is in the US at the moment.
Well, speaking about the market, let's do a sort of portfolio update. Let me bring up our website so I can get the latest, see how we did overnight. Talk about our US portfolio. So our US model portfolio that's been running since September 2023 is up 127% over that period of time versus the S&P 500, which is up 68.8%. So 136 would be double. So we're not quite double the S&P 500, but just shy of double the S&P 500 over that period of time.
With little old value stocks throwing off lots of cash.
Boring value stocks. Yesterday, when we talked, I said that our American Lite portfolio, which has been running just since December last year, was back above the S&P 500. It slipped overnight by the looks of it. It's up 7.5% since December versus the S&P 500 up 9%. It's just peaked above that. But that's okay. It's very early days.
We often see that when we establish a portfolio. It can take 6 to 12 months before it starts to find its feet, so to speak, and perform.
But I tell you, the stock that is doing the best in that Lite portfolio, let me just make sure this is still true. It was true yesterday, was the one I mentioned to you last week, I think, Leslie, the pool company. Oh, they dropped a bit. Oh, okay. They came off a bit yesterday. They were up 10% in a month when I looked at them, but they've dropped a little bit overnight. But they're still doing quite well. All of our stocks seem to come back a little bit yesterday, even though the market jumped up. Might be a bit of profit taking. Don't know what's going on there. Carter Bankshares is doing well. It's up 2% since we added it last week, Tony. So there you go. That's off to a good start.
Well, if we were a stockbroker, we would claim an annualized return of 52 times to 100% on that stock purchase.
Of course, one of our best stocks in the model portfolio is the Willis Lease Finance company that we've talked about probably every week. We've done this for the last year. We added them quite a while ago. They're up 383% since we added them. I'll tell you exactly when we added them. I bought them in November 2023. So very early buy for us. And they just announced a stock split last week. 3-for-1 stock split is going to go through. Now, remind me, what are the implications for existing shareholders of a stock split like that, Tony? Is it a good thing or a bad thing generally?
Well, there's a little bit of psychology going on that the board of Willis must think that the price is now high enough so that it's deterring people from buying it. I'm not sure what Willis is trading at the moment, but oftentimes, think of Berkshire Hathaway. If someone sees a stock worth $300,000 or $500,000, first of all, they may not be able to afford to buy it. So that's an issue. But secondly, it's kind of a psychological barrier as well that, it must be an expensive stock because the stock price is so high. So there's a bit of psychology going on there. But there is a practical reason for a stock split, and why it can work is that if I wanted to buy and sell a little bit of my share portfolio, I've now got a way of doing that without exerting as much price pressure. So in the past, if I wanted to sell one share of Willis Lease Financial, it would be like selling 3 shares today. So I can still sell one share and it doesn't have as much impact on the share price. So that can be of benefit as well. But, it's oftentimes largely psychological.
Right. Well, they're currently trading at about $228, so not Berkshire level prices, but still.
No, but still, some people kind of mentally tune out when something gets above $100.
Yeah, right.
Yeah. They think it's expensive, even though, as we've shown, it may not be.
Well, the share prices continue to tick up after this announcement came out. It was trading at $190. Let's say a week ago, it was trading at 222. It's now at 228. So the market seems to have responded positively, or at least not responded negatively to this.
There was a time when, probably maybe 15, 20 years ago, where just the announcement of a stock split would send the share price rising dramatically. And there was no real logic for it. It's just that people jumped on the bandwagon of stock splits being good for business. And I remember that scene in The Sopranos where Edie Falco wants to buy a share because a broker's told her it's going to split.
Right.
And there's no other reason.
Yeah, just
Yeah,
that.
but she's had the tip. Yeah.
Yeah. Well, unless you've got anything else to talk about news-wise, I'm going to jump into my deep dive for the week, Tony.
No, I haven't, and I'm looking forward to this one. One, because of my retailing background, but two, because it's a very interesting situation.
Well, interestingly, too, I just noticed that when I did my analysis on it over the weekend, it was trading around $19.26, and then it dropped down to $17.21 yesterday, and has climbed back a little bit overnight to $17.72. I don't know what led to the overnight drop of a couple of bucks. That's a big drop. Their results weren't due out. Let me just...
What's happening on the announcement front?
That's what I'm doing now. I'm looking up
dividends.
FinViz. Yeah. News.
Well, we should tell people what the name of the stock is too while we're doing that.
The name of the stock is KSS, or the ticker is KSS. It's Kohls. Kohls.
Different to the Coles in Australia, which is a supermarket, but I'm sure US listeners are very familiar with Coles.
Yeah, every American listener probably knows what a Coles is. And my funny aside is that my wife, Chrissy, who's lived here for 17 years, but whenever she says Coles to Siri, it spells it KOHL apostrophe S and not COLES as it is in Australia. Well, I don't know what happened to them overnight, but probably just makes them a better deal. I can't see any news that would justify this. I do know they have some shorts, which I'll get to in my story, so maybe something to do with that. But anyway, there are for people. I know we have a lot of Australian listeners to the show as well. So for people who don't know what Coles is, they're a department store chain based in Wisconsin, Milwaukee. And they basically sell mid-priced clothing, shoes, towels, kitchen stuff. There's the shop in the strip mall your mum takes you to when you're a kid. Kind of mid-range. They're not the top. They're not the bottom. They're sort of in the middle. When I was trying to understand it from an Australian perspective, it said it's somewhere between Target and Myer. So, not bargain basement, but not Myer level either. So somewhere in the middle. But the interesting thing about this story is last year they hired a new CEO, beginning of 2025, a new CEO who was going to be the turnaround guy. Because as you can imagine, retailers are doing it tough for a variety of reasons. And he'd been in the job 100 days when they fired him for cause. So that's always an interesting story. We'll get into the story of that as we go. They're on the New York Stock Exchange. Market cap's around $2.2 billion. Their own blurb calls them a leading omni-channel retailer. Omni-channel. I could find two. Stores and online. I don't know what the omni bit is.
By channel. Yeah.
Yeah, by channel. Omni. Sounds good. Combining great brands, incredible value and convenience. They've got more than 1,100 stores in 49 states. And they carry, huge brands like Nike, Levi's, and Sephora, which has been a relatively new thing. It's a skincare makeup brand. I'll talk a little bit more later on. It was going to be a big deal for them and hasn't really worked out so far. So, yeah, as I said, they in Australia, they sit somewhere between like a Target and a Myer, a little bit more upscale than a Target, but not quite as upscale as a Myer or a David Jones. The history is they started off as a grocery store. There was a Polish immigrant in the 1920s in Wisconsin, Maxwell Kohl, Kohl, obviously, set it up, built it into a grocery chain. Then in 1962, opened their first department store in Brookfield, Wisconsin, went public in 1992, rode the great American suburban boom, the era of the shopping mall, Mallrats, great Kevin Smith film from the early 90s. Do you like Mallrats, Tony? You ever seen Mallrats?
I haven't, no.
Really? Not a Kevin Smith fan?
A little bit. I like Clerks, but I haven't seen Mallrats.
Oh, Mallrats is a great film. Big flop. It was a big budget. His first big budget film, and it flopped.
Right.
But I've always loved it. Check it out. It's if you like Kevin Smith era style humor, which I do. Very silly, very rude and crude. A lot of nerdy geek stuff in it. I think Mark Hamill might have been in Mallrats. I know Stan Lee was in Mallrats, did a cameo in it. Anyway, shopping department stores. I'm sure you know a little bit about the history of department stores, the department store concept, Tony. You know the history of Le Bon Marché? Le Bon Marché?
Well, I mean, in broad terms, it was basically the emporium. So the idea was before shopping malls, they were the shopping mall. They would bring you a little bit of everything that you couldn't get locally from specialist retailers. And, if they were very good, they might get the finest Paris fashion or the latest cosmetics from overseas and then sell them to people in the suburbs. So that was the business model for the shopping, for the department store. And they do it they do all their purchasing on bulk, so they give you a good price as well. That kind of has been killed since the rise of the Westfields and the other department stores around the world, because that's what a shopping mall is these days. It's basically, instead of having a department store aggregate all that material for you and then sell it to you, you're actually getting the cosmetics from Paris, the brands, to take out to rent a site in your location and sell directly to the retailer. So the department stores have been reasonably disintermediated. They kind of try different things to combat that. So, they'll try and do their own brands, home brands or house brands, as they're sometimes called. They'll try and do special deals with big companies. You mentioned Levi's and Sephora before. That's another way, the kind of house of brand strategy where they become a mini shopping mall again. But generally they're struggling and they're in decline. And online retailing has also been the other battlefront for them. If you don't have a store network and the costs that are associated with that, you can sometimes sell things cheaper to people by just doing a one-off like Amazon and putting it in a cardboard box and mailing it to them. So, they've faced a lot of battles in the last decade or so, maybe 20 years, and they're really struggling.
Well, the story that I read is it goes back to Paris, 1838. The brothers Paul and Justin Vidot set up Au Bon Marché, the good market, to sell lace, ribbons, sheets, mattresses, buttons, umbrellas, and various other assorted goods. Originally had 4 departments, 12 employees in a floor space of 300 square meters or 3,200 square feet. And then 15 years later, they brought in a partner, Aristide Boucicaut, I think. Boucicaut. Boucicaut. And he changed the business plan and the big thing was introducing fixed prices, because up until then you just sort of bartered, you haggled for whatever you were going to pay for. He was like, no, fixed price. That's it. Take it or leave it. Plus guaranteed exchanges or refunds. Those were his big innovations, and a wider range of merchandise as well. But interesting to think about a time when fixed prices wasn't a thing.
Yeah.
You haggled for everything. So, but this blew up. It became a huge hit, fixed prices and guaranteed refunds. Their revenue went through the roof. They absolutely dominated. And then other retailers around the world picked up this idea. Macy's, Marshall Field's in the US copied the business model. So it was the French that invented the whole idea. And these guys, I guess, have been part of that, Kohl's, over the decades. So the core business for these guys today is selling family apparel, footwear, homewares, a little bit of everything. As I said, pitched to the value end, not up at the top, but they're not Walmart down the bottom in the US, somewhere in the middle. Budget-conscious families. Last year, they did about $14.8 billion in sales, and they have their own store credit card, the Kohl's card, which I know you'll like because you're an old card guy.
Yep. And loyalty program guy, and they've got a loyalty program as well.
Yeah. So every time somebody buys a jumper and puts it on the card, they take a slice of the credit economics. That line was about $752 million last year. Tiny next to sales, but very high margins. It's does a lot of the profit lifting for the business, the store card side of it.
Mm-hmm.
The thing that was supposed to be the growth avenue for them was Sephora. Now, I don't know about you. You've got a wife and a daughter. You might know more about Sephora than me. I'd heard of it, but Chrissy's not a Sephora customer. But apparently a French multinational retailer of personal care and beauty products has about 340 brands inside of it, along with its own private label, the Sephora collection. Big with the young ladies, the teenage girls, apparently. Cosmetics, skincare, fragrances, nail polish, beauty tools, body care products, hair care items. Launched in Paris in 1970, named after the wife of Moses, Zipporah, but in French it's Sephora. And so they put a Sephora beauty shop inside a Kohl store back in 2021 and then started rolling it out to their other stores. Supposedly was going to drag younger shoppers through the door, but hasn't actually worked. In the last quarter, when they did their quarterlies, it was actually a bit of a drag on their numbers. So they're looking at other makeup skincare brands as an alternative. But beauty did over $1.8 billion for them last year, so it is a big part of their business. They also have their Kohl's signature line option. I tell you a funny thing. I was talking about Chrissy's Siri. So I dictate my notes as I'm, preparing each week, and my dictation engine is spelled at COLES all the way through and not KOHL apostrophe S. So I'm having to fix it as I go. They have their signature line option, which is actually doing quite well for them. But we'll see that when we get into the quarterly numbers. But let's get into the fun bit, the fired CEO. So, as I said, January 2025, they bring in this new boss, Ashley Buchanan. Going to come in and turn around the business. 15 weeks later, they had to fire him. So it's a great story. Soon after taking over, he brokered a deal for several Kohl stores to sell products from a coffee startup called IncrediBrew. I looked up IncrediBrew. They seem to be pods, but they're like boutique pods, like coffee and mushroom. You were talking about coffee off air this morning.
Yes.
How your coffee beans are getting smaller.
Mm-hmm.
They sell like, your boutique brand coffee things, fancy coffees for, I don't know, modern age coffee snobs who like fancy stuff in their coffee. Anyway, it's headed by a former Bed Bath & Beyond CEO, a lady by the name of Chandra Holt. And somebody on the Kohl side of things, when this deal was done, expressed some concerns over the terms of the deal that IncrediBrew were getting, how they hadn't gone through the normal vendor vetting process, and made some complaints about it. They got ignored, took it up to the board. The board launched an internal investigation, and it emerged that the new CEO, Mr. Buchanan, and the CEO of IncrediBrew, Chandra Holt, had worked together at Walmart and had been in a secret romantic relationship for several years.
Is this all proven, Cam, or is this alleged?
He confessed to it, Mr. Buchanan,
okay.
yes. Right. Yeah, when the investigation happened, he admitted it, which is why he was fired. He had also crafted a consulting agreement with Boston Consulting where Chandra Holt was an advisor. So he got fired the next day after all this came out. And the chairman, Michael Bender, stepped in as the interim CEO, and then they made him permanent CEO in November last year. They also got a brand new COO who's just come in the last month or two from Foot Locker. Like, you and I wrote a book on the psychopath epidemic 5 or 6 years ago, Tony, and one of the things that led to that book and me thinking about psychopaths was, why do we always hear these stories of people in positions of authority and power, whether it's in business or government or the military or leading religions or you name it, who just do really, really stupid shit. Like really, really stupid shit. Where you would think you should know better.
Mm-hmm.
You know, you're not 20. I don't know how old Mr. Buchanan was, but I've seen photo of him. He looks like he's, middle-aged guy. Obviously had some success, run companies, brought in to, run one of the largest retailers in the United States. This is a really rookie amateur mistake. Like, how did he not think that was going to get found out? And I'm not claiming that Mr. Buchanan is a psychopath, but one of the things that we learned in researching and writing the book is one of the characteristics of psychopaths is they have a very high appetite for risk. They believe that they are superior to mere mortals. And quite often, if they've got to a certain point in life where they have taken enormous risks and gotten away with it, they seem to think that they will always get away with it. They can just do stuff and it'll just work out. I think Donald Trump fits this archetype. Just does, I'm going to just put tariffs on everything. I'm just going to start a war. I'm just going to do stuff. It'll be fine. It'll work out. It'll be great. And then it doesn't. Eventually, sometimes it bites them on the ass. But, if they've gotten away with it for 10, 20, 30 years, they think they'll always get away with it. So,
it's, in some respects, it's human nature writ large, isn't it? I'm sure there are lots of situations about people being in secret relationships and helping each other out at every level of society. It just becomes the focus of attention when it's a CEO involved. But you're right that you'd hope that the CEO who is running a company would have the probity to, if they're in a secret relationship, good luck to them. But why do sweetheart deals when you know that it's a department store. Their whole IP is around screwing suppliers and getting the best deal for their customers. Why did they think they wouldn't get found out?
Yeah, it's astonishing, but there you go. It
is, yeah.
So I think that had probably a little bit of an impact on their share price at the time, but it doesn't really explain why it's turning up on our value buy list today. If you look at their share price, it was $14 at the beginning of January last year. When this all went down, it dropped down to $6.13 by April of 2025. Then got back up to $24.71 by the end of last year and has been struggling in the last 6 months. But it's getting back up, it's climbing back up until yesterday. It fell again, but it's sort of is still recovering. So another couple of things before I get into the financials and some of the story from their Q1 report. Early 2025, they also cut their dividend by 75% from 50 cents a quarter to 12.5 cents. So that would have had an impact on their share price. People that owned it for the dividend wouldn't have been happy about that. Management called it balance sheet flexibility, which I think translates as we probably need the cash.
Yeah.
Now, of course, got to remember that this is Liberation Day time as well. This is a retailer that probably very, very large chunk of its stuff is getting made in China and Vietnam and places like that, which we're going to attract a huge chunk of tariffs under the Trump tariff regime.
I did notice when I was doing my research that they've just submitted legal claims in June of this year to have $140 million US refunded for tariffs that they paid. Now that the tariffs have been questioned, their legality's been questioned.
Yeah, well, I've got more on that later on. It's murky. All of this tariff stuff is still murky, and they call that out in their latest report. They don't really know what they're supposed to be paying, what they might get back, and so it's all big question marks in their official reporting, which is fair enough because it's still in play. There's still, stuff going on through the courts.
Mm-hmm.
The other interesting story that happened last year is they borrowed $360 million at a 10% interest rate and had to provide security, had to pledge the furniture in order to get it. So a 10% secured bond is my analysis of that was sort of it's the bond market telling you they don't think you're a great credit risk. That's a pretty high interest rate to be paying in the current market, and particularly if you have to secure it. So the bond market thinks that they're facing some challenges, which is understandable, being a bricks and mortar retailer in the current era. Plus, they closed 27 stores in 2025 and some distribution centers. 27 out of 1,100 is not a big deal, but it tells you a little bit about how business is going, and we'll see that when we get into the numbers as well. Numbers have been going backwards for quite a few years, but there's also some stuff turning around, which might be some sign of hope. But another thing that you'll like is that they own their own real estate.
Yeah, that's what I wanted to focus on. That's the interesting part of this story for me, I think.
Yeah. I got a rough valuation of about $6.8 billion of property on the books.
Yep.
And activists have been pushing them to Gordon Gekko for quite a few years. There's corporate raiders circling. There was a group called the Franchise Group that had a deal at $60 a share in 2022 before it fell apart. Don't know why it fell apart. Didn't drill down into that. It's a bit too long ago, but $60 a share right now sounds pretty good.
Yes.
The share price was trading at $61.63 at its peak in March of 2022. I guess, probably had Ukraine war going on then. I don't know how that impacted. But there was also trade wars going on with China. I don't know what else was happening then, but yeah, coming out of COVID, maybe they had some good online shopping during COVID stimulus. Their share price went up a lot during COVID. Anyway, there's still a lot of chatter bubbling up around this, and it does seem like that's a huge asset base that could be sold off. We've done a couple of, who was it we were talking about some months ago? Was it Kodak? Somebody like that we talked about that had a lot of real estate that they had spun off.
Right, I think it was.
And leased it back. Yeah. So there seems to be a lot of opportunity for them to do something good with this, to offload this real estate and, use the money to do other things in the business.
Well, that's the really interesting point for a company in this situation, whether it happens a lot with department stores, or historically it has. But, if you look at their net profit number, their most recent net profit number, I think it was about $270 million, and their forecast numbers are lower than that, 160. I think you said that they had a property portfolio of over $6 billion.
6.8.
Yeah. So if that's the case, then, if they just said, well, let's just lease out the $6 billion of property that we have, what kind of yield would you expect on good commercial property and shopping malls and good locations in suburbs and things? You'd probably get at least 5%, maybe
5 or 6%.
Yeah, at least. So, 10% on 6.8 billion is 680 million. Half of that, 340. It's more than what they're making from the department stores. And they could do it, with next to a very small staff footprint to manage the commercial real estate. So I don't begrudge them for saying, look, we'll turn things around and we'll get back to a stage where we'll earn more money from being a department store than we do from renting out our real estate portfolio. But, how many chances do you give them, given that department stores are in decline? And at what stage do they get another private equity company bidding and saying, we're going to shut you down. You're just a waste of space. And we're going to take the commercial real estate over and rent it out.
Yeah.
It's got to happen. And the obvious play for Kohl's would then be to do what's called a sale and leaseback strategy, which has been used a lot in the past by retailers, where they'll sell off their property arm or spin it off into a real estate investment trust and then get a guaranteed lease for a long period of time so they don't get shuttered. That I don't think will work in Kohl's case, because if you think about it, the reason why they're not doing that is because the rental is more than what they're making in profit. So it'd probably send them bankrupt. And there has been cases in the States in the past where that sale and leaseback strategy sunk department stores. I think it may have contributed to Sears going under. So, but yeah, I mean, if you're a department store retailer and you can't make rent, then why are you in business? I mean, really, that's the question, isn't it? So unless they come up tomorrow with some fantastic offering, whether it's Sephora or whatever else they can do, I'd be inviting people to come back and bid for the real estate property and get out of the department store business, really.
Yeah.
That's the interesting dilemma, I think, if you're a shareholder.
It's a bit like being an active fund manager and you can't beat the ETFs. Like, why do you even exist?
Yeah. Well, and you own a portfolio of ETFs, right?
Yeah.
Yeah. Shut down and sell the ETFs and you're in front, or shut down and run the ETFs and you're doing better off. Same thing. So that's what I find interesting about this. And I'm surprised, I wasn't surprised to see they got an offer of $60 a share. If that's the valuation of the real estate business, I'd be voting the board off, directors off the board and saying, inviting someone to come back in and give me another $60 offer, really.
Yeah, because at the end of the day, you're looking, this classic Gordon Gekko stuff, right?
Yeah.
You're looking at the value of the assets and what the return on the assets is and what it could be.
Correct.
A lot of employees, they're going to lose their jobs if you shut down the business, and there's that side of it as well, the impact of all of that. But
yeah, it's not an easy thing to shut it down.
Their jobs anyway.
There'll be lease liabilities, because I don't think their property network isn't 100% of the store network, so they'll still have lease liabilities to get out of and all. But at some stage, there's a tipping point here where you're better off shutting the department store and leasing out the real estate, or even selling the real estate, really.
Anyway, getting back to their actual business today, obviously some of the things that are affecting retail, particularly their target demo, sort of middle class value buyers. We've had the impact of tariffs, we've had inflation, gas prices, etc. Their most recent quarterly report says, we expect that our operations will continue to be influenced by general economic conditions, including food, fuel, and energy prices, higher unemployment, wage inflation, and costs to source our merchandise, including tariffs. Only a fifth of their stuff comes from China. I thought it would have been a lot higher, but there you go. So even though the Supreme Court issued a ruling that struck down certain tariffs back in February, there are still some tariffs from the first trade war using a different, mechanism that are still standing. And as soon as the Supreme Court knocked down the ones from last year, the Liberation Day ones, Trump slapped fresh tariffs on using a different power. The Court of International Trade ruled those unlawful too, but it's pending appeal. So Kohl's is, I think, still paying them and waiting for the lawyers to fight it out. As you said, they've also put in a claim for getting tariffs paid back, clawed back, but they're still not sure whether or not that's going to happen. No one really knows. So it's a complete mess. They're paying tariffs. They're not sure they should be paying, but they're paying them anyway. They're trying to claw back stuff. They don't know they're going to get it back. Anyway, so it's a complete schmozzle, as we've said many times before, which is what you get when you put a reality TV star in charge of the government. In their most recent earnings call, the Q1 2026 earnings call, they said net sales declined 1.7%, comparable sales declined 1.1%, digital sales grew 4%, gross margin improved by 4 basis points year over year, so that's good. The net loss was $14 million for Q1 2026. They're sitting on cash and cash equivalents of $429 million. But the good news is they achieved their best quarterly comparable sales performance in over 4 years, driven by a significant stabilization of the core Kohl's card customer. That's a mouthful. And who reached a flat comp versus a mid-single digit decline in Q4. So there's some turnaround news in that, and I think that's why the share price did tick up a little bit in the last couple of weeks. Proprietary brands outperformed with a 6% comparable sales increase, which is good for them opening different price points for customers that are struggling with inflation pressures. Sephora, as I mentioned, underperformed. It had a low single-digit decline, especially in makeup and skincare. So they've said that they're doing a full rollout of the MAC skincare brands and Korean skincare brands. Do you know anything about Korean skincare? My wife is obsessed with Korean skincare.
I know a little bit about MAC, Makeup Artists of Canada, because that's the one that Alex.
Oh, is that what it stands for? I didn't know that.
Yeah. Big in Toronto, where we used to live, but don't know about Korean makeup.
So Korea. So my wife, for
in case
people
you
who
can't
don't
tell,
know,
I don't use makeup.
or skincare. Yeah. My wife, who's an American, but has lived here for 17 years, teaches violin.
Wow, has
and
it been that long?
Yeah.
Gosh.
This week is our 18th anniversary of when we met in Corsica. It was this week 18 years ago.
Gosh.
Yeah, I know. That's what we say. Wow. Where was I going with this? Oh, she's a violin teacher, and she has had a lot of Korean students over the years. And they always bring her, when they go back home, they come back and they bring her Korean skincare, and she loves Korean skincare. Koreans apparently are obsessed with beauty and skincare and all this kind of stuff. South Koreans, obviously. North Koreans, not so much. Kim Jong probably has his own brand.
They're concerned with their skin, but for a different reason. Trying to keep
keep it, yeah. So anyway, they're rolling out Korean skincare brands, which are hot. The hottest thing in New York nightclubs is Korean skincare brands. So we'll see if that helps. Anyway, when the results came out, their share price jumped 10.9%, and then it came back. As I said yesterday, might have been a bit of profit taking, seeing as I can't see anything in the news. But there's this other funny thing. They had this weird meme stock thing happen about a year ago as well. After the whole Buchanan thing happened, it looks like there was this massive short squeeze that happened. So we talked about this, I think it was last week, we talked about the gamma squeeze.
We did. Don't make me angry. You wouldn't like me when I'm angry.
The Bruce Banner. Oh, man, speaking of that, YouTube must have heard me talking about that because it showed me a clip from the Hulk TV series, the Lou Ferrigno TV series, with Thor, which I'd never remembered. Apparently, he met Thor at one point, and the Hulk fought with Thor, and it was just glorious to watch. Bill Bixby.
Yep.
Don't make me angry. You wouldn't like me when I'm angry. And then Thor is like being this complete dick to him, and he turns into the Hulk, and they go at it. Oh, Lou Ferrigno's body, man, it was insane. Looking at it, like obviously crazy compared to what we're used to with the Marvel Hulk these days, but his body was insane. The muscles that he had on the back of his neck and whatever these deltoid quad things, I don't even know what they were, but anyway.
Competed with Arnold Schwarzenegger for Mr. Universe titles.
Yeah. But he looks bigger than Schwarzenegger. Like Schwarzenegger looked like proportionally great, but Lou just looked, at this point anyway, early 80s, I guess, just massive. Anyway, back to Gamma Squeeze. So July 22nd, 2025, the stock doubled when it opened. I told you it sort of hit this crazy peak. Let's go the last year. Yeah, so it was $9.36 $13.39 and it leapt to $14.34. And then it went up 100%, then it closed up 39%. Volume was 25 times normal on that day. No earnings, no news. And apparently it was a short squeeze.
Right.
So 49% of the float had been sold short.
Wow.
And
another vote against the board.
well, yeah, I guess. And then retail traders piled in and the shorts had to buy back to cover and it went vertical. So another one of these gamma squeeze things, crazy, crazy stuff. Anyway, the price today probably has some of that squeeze residue still baked into it. There's still quite a bit of shorting going down, but from what I can tell, it's down to about 28% of the float. But that's still
a lot.
A lot, right? A lot of the stock to be involved. So we don't factor that in our checklist, and I don't know if we should, but...
Well, we've had that. I've had that debate myself in the past, and, you know, happy to fight the shorts. They think it's going lower, and we think it's going higher.
Yeah, right.
In this case, you know, you'll go through the numbers, but with all that real estate backing it, I think it's a reasonably safe bet.
Yeah, like the business, you know, it seems to be, at least for one quarter, seems to be turning around, doing well. It's cheap on our metrics. I'll run through the, did I put my analysis here? I've got so many notes here, I can't even find the bit that I need.
Maybe it's under COLES.
No, I've got like 4 versions of the notes here because I consolidate all of these things and then I do another thing and another thing and digital sales, scorecard. No, this is it. Okay. So let me see. What did I score it? So the share price, as I said, was about $19.26 when I did my analysis. So now it's down a couple of bucks. This will have changed in some respects, but at the end of the day, not that big a deal. Market cap was 2.2 billion roughly. Average daily trade about 103 million. So big enough.
Just let me. So you're sure the real estate value is 6.8 billion?
I'm not sure, but that's the number I came up with in my research. Yeah.
And the market cap's 2.8 billion.
Yeah, right. That doesn't make any sense, does it?
No. But again, another reason why I would think private equity is looking at this one.
So Stockopedia rank of 97.
Very high, isn't it?
Hear. Yeah. Sorry, your typing was very loud.
Oh, I'm sorry.
It's all right.
No, I'm just checking
like
that real estate backing. It's it's 6.8
you got
to
the
7
same
billion.
number?
Yeah.
Yeah.
And also too, I think I noticed in my research that it's down in their books at cost. It's not even, you know, the current value of it.
Really?
I don't know if that's the case. I'd have to double check that, but yeah. Yeah. So it's saying here that it could be worth as high as 11 billion.
And the market cap's 2.2.
Yeah.
That's crazy. So the Stockopedia stock rank was 97, scored it for that. Stockopedia quality rank was 74, scored it for that. The Piotroski F-score is a 7, so it scored for that. Its price is not less than our IV1 or our IV2. To give you an indication, my IV intrinsic value number 1 is $8.30. My intrinsic value number 2 is $14.81, so it's above both of those. Double the share price at the time would have been $38.52. So obviously doesn't score for that either. The price is less than the book value, though. The book value I have is $35.48 equity per share. So it scores for that. Obviously, it also scores for the price being less than book plus 30. It had positive growth. The dividend yield is not higher than the benchmark rate. I got the dividend yield down at 2.6%. But I didn't score it for a new 3-point upturn, even though it should have. This is funny. So my code said no. When I looked at the Brenelator, which for new listeners is a Google Sheet tool that we've had for years, it said it was just above it. When I tried to figure out the difference, when my code ran, it was 1 cent below the buy price.
Yep.
Oh, the buy line. So anyway, but it should have got a point for that. Wouldn't have made much difference, but yeah. At the end of the day, I gave it a QAV quality score of 69.23%, which is pretty high, but it got, its PropCaf was 1.56, price to operating cash flow, 1.56. So it ended up with a QAV score of 0.443, which is pretty high. So it scores well. It's making money. Kind of, turning around maybe, but even if it's not. So it's, it's sort of a cigar butt in a way.
Oh, yeah. It's a dinosaur.
It's a cigar butt, but it's got sort of a turnaround operation bolted on a little bit with the makeup and the skincare and the online stuff, which is doing okay, maybe. Best quarter that they've had in 4 years. So maybe facing a lot of headwinds with tariffs and inflation.
This reminds me of the original Berkshire Hathaway, right? The cotton mill that didn't make any money, but Buffett had managed to buy all these assets that made a lot of money with the cash flow from the cotton mill, and eventually you shut it down.
Yeah.
I mean, where's Buffett or where's Gordon Gekko when you need them to just give this stock a shake? A cleanup.
Well, they're circling it. Like there's a lot of things going on as far as I can tell. So yeah, it's throwing off a lot of cash while it shrinks, trading at roughly half of book value, and has a very low price to operating cash flow. And as we've figured out, is sitting on a ton of real estate that has enormous value. So somebody's got to figure that out and
I know the board,
do something with it.
The board have argued that the real estate's is of value to them because they can shrink or grow their footprint without having to change the rental that they pay, and that makes sense. That's good. Or they can bring in subtenants, which might be the latest trend, like Korean makeup or whatever, and that's good too. But they've had a long time to perfect that strategy, and it's not really working for them. And they're in a declining industry. I'd much rather see them just shake it up and say, maybe we should be 1,000 stores, not 11,000, 1,100, and then maybe it should be 100 stores rather than 1,100, and we'll sell off our real estate and return some money to the shareholders, something like that.
Yeah. I do want to point out, though, that it is not a buy today because the share price has gone down. So my current buy price is $18.86. It's now down to $17.72. So it's slightly below the buy price as of today. It was a buy yesterday, and I did add it to our portfolio yesterday, and I sent out an email to our Lite subscribers. So if you got in quick, you've lost money, but you have it in your portfolio. So we'll see what happens with it. But if you didn't buy it yesterday, maybe wait until it gets back over the buy price. But it's ticking back up again today, so I think it will get back up. But I don't know why it dropped yesterday. It's very strange.
Yeah, who knows? Could have been a short position taken up. Who knows? Yep. Maybe
anyway,
maybe Korean makeup's attracting extra tariffs overnight. Who knows?
Who knows? But I like it. It's, again, as you said, like it's sort of it's a classic value stock, boring, dying, generating cash, a lot of assets, just smells like a good deal. So
it does, doesn't it? I don't want to predict, but I'd be forecasting that if we can see value in this, there's got to be an institution out there which is seeing value in it too, and they'll put it in play somehow. Yeah.
And that happens so often in my experience with QAV over the years, that if we think it's a good deal, somebody else is going to figure that out and take advantage of it.
Yeah, absolutely.
Well, that's QAV America for this week, Tony.
Yeah, very interesting. It's a good stock to analyze because a lot of people will have an opinion about Kohl's in the US, and our listeners will be thinking, "Oh, I don't go there," or "I've got a card and I always go there." And it can be very polarizing when you talk about something which is used every week by investors.
I'll throw it up on the value investing subreddit and see what people say. I threw up a thing about Carter Bankshares last week, and people seem to like that. They like that story, so
Okay.
It was a good story too. The whole Jim Justice story. And as somebody on the subreddit said, credit to the current management at Carter for unpicking that unholy mess, because they did a good job, came out of it on top, so good for them.
Yeah, a bit. I mean, that Greenbrier situation is a bit like Kohl's, isn't it? It's an asset that can be spun off and realize some value for it to support the underlying business or to help shareholders.
Yeah. I mean, difference being, wasn't really core bank business. They didn't have to shut down a branch to sell that debt off, but similar. All right. Thank you, TK. Have a good week.
Thanks, Cam. Well done.